Choosing between a rental property and an index fund usually comes down to dinner party stories or YouTube headlines. But when you map the numbers over 20 years, the gap between what you think you're making and the profit that actually stays in your account is often wider than expected. By the end of this video, you are going to build a personalized, true risk and return calculator. We will cut through the napkin math, expose the hidden costs of both paths, and calculate the exact strategy that fits your actual lifestyle. Step 1 is to gather your materials. Grab a blank spreadsheet or a piece of paper and write down a starting capital amount. For this baseline test, we will use $50,000 saved, assuming an annual income of $55,000. Skipping this personalized mathematical stress test is the real financial trap. Making a 10 or 20-year commitment requires mapping out the actual dollars, hours, and risks involved before you sign a mortgage or a brokerage agreement. On your tracking sheet, log your baseline numbers. You have $50,000 in starting capital and an automated $300 monthly contribution you can comfortably commit to your investments. Let's run the real estate scenario first. You use your $50,000 as a 20% down payment on a $250,000 property. You find a tenant paying $1,800 a month, and your mortgage is $1,330. On paper, subtracting the mortgage from the rent leaves $470 a month in profit. Standard napkin math creates a dangerous illusion of profit by stopping the calculation right here. This chart shows the true cash flow equation. We start with the gross rent bar, but now we must deduct the hidden costs. First, add a line item for vacancy. The average rental property sits empty about 1 full month per year, requiring you to make a full mortgage payment with zero incoming cash to cover it. Next, deduct maintenance and capital expenditures, or CapEx. You must budget 1 to 2% of the property's value annually for regular repairs. Then, you have to hold back reserves for future replacements, like roofs or HVAC systems, which arrive as 5-figure expenses that cannot be postponed. Finally, subtract property management. Outsourcing the tenant screening and late-night calls immediately removes 8 to 10% of your monthly rent. Look at your remaining bar. That $470 napkin projection is now a tiny fraction of the original number. If you decide to keep that 10% and self-manage the property, you must apply the part-time job rule. You are saving cash by taking on unpaid labo, managing weekend showings, and coordinating repairs on your lunch break. Failing to budget for these 4 specific line items means you are not running a real estate business. You are just relying on luck. This equation calculates your local market risk profile. By dividing your monthly rent by the total purchase price, you find your rent-to-price ratio. For the cash flow math to work in your favor from day one, you need this to land in the 0.8 to 1.0% zone. At a 7% mortgage rate, a $250,000 home costs about $1,330 a month in debt alone. If your rent is below 0.8%, or $2,000, the remaining $670 is quickly consumed by the taxes, insurance, and maintenance reserves we just calculated. Below this threshold, your monthly profit is often too thin to survive a single month of vacancy. You must also account for unquantifiable risks. A single bad tenant who knows the eviction process can cost you 3 to 6 months of lost rent, plus legal fees, erasing an entire year's profit in one event. Real estate does have a core advantage: leverage. Using $50,000 of personal capital to control a $250,000 asset means that every percentage point of appreciation is calculated against the full value of the home, not just the money you put down. Leverage is real estate's primary wealth generator. The inescapable trade-offs for that power are intense concentration in a single zip code and a significant ongoing time commitment. Let's transition to the second column on your sheet. You drop the same $50,000 plus that $300 a month into a total stock market index fund at a 10% average historical return. This chart visualizes compound growth. The wealth generated by index funds grows in a curve, requiring absolute patience and zero physical intervention. The psychological difficulty of this path is obvious on the timeline. For the first 5 years, the growth is boring and slow. By the final 15 years, the gains on your gains begin generating more new wealth each year than your original contributions. Instruct your sheet to increase your monthly contribution by just $200. This relatively small change adds nearly $140,000 to the 20-year final balance, because that extra money compounds alongside your initial $50,000. Stock index funds require zero weekend labor. But the mathematical power of compounding only unlocks if you possess the discipline to leave the money completely untouched. We have to stress test your emotional risk tolerance. Stock market returns are never a straight, smooth line. Looking at the 37% drop in 2008 or the 34% drop in March 2020 proves the reality of the market. Brutal, unpredictable volatility is an absolutely guaranteed feature of this entire financial system. Run this visual stress test for yourself. Imagine watching your $150,000 portfolio plummeting to $95,000 in a matter of weeks. The behavioral risk of panic selling destroys the math. Selling your shares during a severe market drop permanently locks in your losses at the worst possible time. You must also accept the structural disadvantages of index funds. They provide almost zero spendable cash flow for your daily life, and they lack the legal tax shelters, like depreciation, that actively reduce a real estate investor's taxable income. Stock market risk is a psychological battle. You trade the physical repairs of a property for the requirement to endure gut-wrenching portfolio drops without interfering with the asset. Check your completed sheet. This matrix plots the final decision framework, asking you to evaluate your personal stance on time versus leverage. Real estate wins if you demand leverage. You want legal tax shelters, your local market hits that 1% rent-to-price ratio, and you are fully willing to treat the investment as a part-time business. Stocks win if you demand complete liquidity. You want a zero-time commitment, and you can stomach high volatility to achieve passive compound growth. The decision comes down to the source of your growth. Jake spent 2 decades managing labor and debt, while Marcus spent 2 decades managing his own discipline and patience. Execute your chosen path today. Either hunt for a property that meets the 1% ratio or automate your index fund deposits right now.